Hi, it's Harry. I thought today we should talk about different types of mortgages. My previous video yesterday was about the various government programs and CMHC insured mortgages. And recently someone asked me what how variable mortgages work. So basically there are two types of mortgages. As I mentioned earlier, there is a variable mortgage and a fixed rate mortgage. What a variable mortgage means is that the the rate of interest that's charged to you on your mortgage varies with the bank rate. Whereas a fixed mortgage, that rate is held steady for whatever term you choose, which could be as low as 6 months all the way up to 10 years. Most people are in that 3 to 5 year period. The big deal about this is variable mortgages. You you can basically end a mortgage with a 2 month interest rate penalty. Not so for the fixed mortgage. A fixed mortgage, sometimes they can charge you the differential for the remaining term of the mortgage, which means if you decide to break the mortgage because you're selling your home, it can be quite significant in the sense of thousands of dollars, especially if the interest rate has gone up, gone down versus the interest rate you initially set the mortgage at. Whereas the variable one fluctuates up and down, so the bank doesn't really lose. You just have to remember the bank is a business. If they're offering you a fixed mortgage, they've already built in their estimate of what interest rates are going to be in the future, and they'll put some form of an insurance or differential on that rate so they keep themselves covered. So with respect to I'm hopping around here. With respect to variable mortgages, when their interest rates go up, you pay less on the principal, and when the interest rates go down, you pay more on the principal. Just be aware that your amortization term can change. Although your payment, the banks keep the payment the same, they just vary what you pay off on the principal. Whereas in a fixed mortgage, the principal payment is set and the interest rate is set. So that's something you have to think about. When you believe the interest rates are potentially going down, it might be something you want to do to lock it in. I find fixed mortgages useful if you need to budget. If you can live with the variability and your income allows for it, it's usually better to go variable because there's no what I call the insurance factor that the bank puts on their mortgages as to allow them a cushion if the mortgage rates go against them. Now, with respect, when we talk about open and closed mortgages, which can be applied to both the variable and fixed, a closed mortgage, the terms are set in the sense it's a 5 year term or a 3 year term or whatever. Whereas an open mortgage, you can pay off your mortgage anytime with no penalties. However, because of that, the banks charge you a higher interest rate if you want an open mortgage. But mortgages, the other thing you have to think about in mortgages, I'm extending this talk towards the terms. So consult a mortgage broker. They work for you because if you go to a bank loan officer, they'll help you out, but remember they work for the bank, not for you. And the terms are important because what some of these terms allow you to pay down your on a yearly basis. You can pay down your mortgage or principal by 10 to 20%, depending on the term. So that allows you, especially when you're first starting out in your career, to pay down your principal quicker as potentially your salary increases. You get a bonus at the end of 1 year or you get promoted. That extra funds can go towards your mortgage, reducing your amortization period. So a very handy thing to have. Some people even ask for portable mortgages where you can move it from one house to another. It's not used as much, but it can be handy. So hopefully this has helped you with a thought about what different types of mortgages there are and how they work. If you have any questions, please reach out. My email obviously is in the YouTube here, or just give me a ring and we can talk at length about how the mortgages could potentially affect you. If not, I can get. If you want greater detail, I'll hand you off to my mortgage broker that I work with, and she can explain the minute details that come with mortgage terms and issues. Hopefully this is helpful. Otherwise, have a great week. Bye now.